Hi everyone, I'm Pamela Hastings and welcome you to another Barometer webcast. We're just going to wait here for a couple minutes. We'll start in 2 minutes as we let everyone log on to the call. It's great to have you here. So while I have your attention, if you have any questions or comments, please don't hesitate to send them via the chat, or you can email me at phastings@barometercapital.ca. We will be answering questions after David provides his global macro update and look forward to addressing them. And joining us this afternoon is our Chief Investment Strategist and President at Barometer Capital, David Burrows. Hi, David.
Hi, Pam. How are you?
Great, thank you. How are you?
I'm great, thank you. I hope everybody's enjoying this last couple of sunny days. We got to save them up for winter. Thanks, everybody, for joining today. Markets over the last couple of weeks have been a little bit bumpy, so we got lots of stuff to talk about, not completely unexpected. And I think that we've got lots of stuff to cover. So why don't I just jump in? There we go. Wrong deck. Just give me a moment while I switch that up. There we go. Okay. Let's start again. Okay. As everybody knows, we're trying to do three basic things in the portfolios that we run. They sound simple. They're not so simple. Everybody's got an expectation of getting a return, which means we've got to find the parts of the market that matter. We're not interested in being in every sector all the time. As you'll see, there are lots of sectors we want to avoid. So really, we're trying to drill down and use the tools that we have to identify market leadership. And when I say market leadership, I mean themes or sectors where there's some structural change taking place that supports higher valuations over time. So not only do we get some earnings growth, but we get some multiple expansion, and that really adds to share price performance. Now, not always easy to find, but once it gets in gear, often stays in gear for quite some time until it isn't. And it's our job to recognize change, new leadership as it emerges, and old leadership as it recedes, so that we can make sure that the portfolios stay relevant. So we are not trying to replicate the index. It tends to be that we have quite a low correlation to what's going on in the index. We're trying to be in productive assets. And then, of course, there's some times when it makes sense to have a little bit of cash or to be out of big parts of the market. And certainly there's some things to talk about around that today. So what we are trying to do is be tactical. We are not going to be fully invested all the time. We are not going to be in every group. We really want to make sure that the things we own are effectively, fresh produce on the shelf. If it starts to wilt, we want to move on. So if I just take a broad backdrop picture of the market, this is the S&P going back to the early 1990s. We know that we went through a structural bear market between 2000 and 2012, where the market made no headwind, but covered lots of ground. And effectively, at that point, we broke out and made a new high. At that point, earnings multiples started to expand. And since then, market's been pretty good. There certainly have been interruptions, a big interruption in 2015-16 in the Chinese slowdown. A very sharp correction in the fourth quarter of 2018, but maintained this long-term bull market. We had a very sharp pullback in February and March, which really looks big compared to these others, but it's because it's a nearer-term pullback. And then we rallied through until about a month ago, and we've been pulling back over the last few weeks. But to be clear, we are in a structural long-term bull market in stocks. Equities are being revalued versus other asset classes. And that is something that we think continues on whether we're correcting here or not. The Nasdaq, of course, has been the star, and it's been, it went from 2000 until 2016, 16 years without making a new high. Through that time, a lot of these companies became very, very profitable and just real machines. And certainly the market has been recognizing them for that over the last 3 years. If you look at off the bottom in March, this group obviously had a very, very sharp rally. And in fact, so sharp that it extended right out of the channel that it's been in over the last several years, which never is really sustainable. And of course, we've been pulling back over the last month. We had the decline in February, which was the sharpest 1 month bear market in history, sharpest and fastest. This is against all bear markets going back to 1927. And then we had a very sharp recovery, which I think startled a lot of people. Thank God we had the breadth models that we used that first of all forced us out of the market in February and pushed us back in at the end of March when certainly it felt bad. But clearly there was improvement taking place in the internals in the market, and we could see that money was getting put to work. We could see the monetary stimulus being brought to bear on the market and the fiscal stimulus. And I think the market really surprised people coming out of that. So if we take a closer look, this is the Nasdaq since March, and this has been by far the best performing market in the world. So we don't want to compare everything to this, but this has been the strength, and this was an important driver of returns for us. And this would have been made up of companies in cloud computing, companies in cybersecurity, companies in the semiconductor industry, companies in artificial intelligence, a lot of the newer disruptive technologies changing the way that we do things. And certainly the pandemic accelerated the adoption of many of these technologies and accelerated spending, and certainly brought awareness of these to investors. Now, if we come up to the end of August, things did get extended. We talked about the fact through late part of summer, we expected some sort of correction in the market, 10 to 15%. And this is what we're getting. We have been pulling back. We pulled back. We attempted to rally, failed, pulled back, attempted to rally, pulled back again. We're sort of in and around the lows today. And certainly, you know, there are some stocks that are broken, but there's a lot of companies that have just simply pulled back within their long-term trend. Look, when we talked in August, at the end of August, there were some things that we pointed out. First of all, the number of people shorting the market had really contracted. In other words, the run up in the market had squeezed in the short sellers, leaving the market with very few shorts. We knew that sentiment had come to a point where it had become really, really protracted or quite euphoric. We highlighted the fact that the number of people buying puts versus the number of people buying calls had become very narrow. In other words, mostly call buying was taking place, people making a bet on higher prices. So when things get stretched like that, it becomes inevitable that at some point you have some kind of a pullback. We know that private clients, individuals sitting at home, trading at the discount brokers really got enthusiastic. And we know that because we know that the call buying, the number of small volume call orders went through the roof compared to history. So this arguably is probably a lot of inexperienced investors who maybe didn't understand some of the risks that they were taking on. So let's talk about what we have learned over the last little while. The last webcast that we did, we talked about the fact that some of our indicators were starting to become more tenuous. Now, what we look at is we look at the makeup and the behavior in the market to try and understand whether money is being put to work or whether money is being pulled out. And there's lots of things that we watch. We watch also sort of high frequency data. We know that people were very excited about the fact that through June, July, and August, there was improvement in some of the near-term sort of high-frequency data, things like visa spending, number of people going through airports. This is a measure of the number of people booking restaurant reservations on OpenTable. And over the last 3-4 weeks, we've started to see some moderation in that. Now, it may be that this is people being concerned about a second wave. Certainly the COVID numbers in Canada are ticking a little higher. We certainly know that they're ticking higher in Europe. And so there is concern about another slowdown. So that's something that we've got to watch. We also are aware that we're about 60 days from a US election. And I think that there are some things that the market's concerned about around the election. I think of prime concern is the fact that in this election, we are likely to see an inordinate number of mail-in voters. So on election day, it is likely in the initial ballots coming in that the Republicans will have a stronger showing at the ballot poll where people are less concerned about COVID, and where the Democrats are maybe a little bit more concerned about COVID, those votes may come in through the mail, and that may take a little bit longer. So there is some concern that there is going to be, some unrest around this election if it's close. And I think that there are things to worry about when it comes to that. If we look at the Canadian market rallied, it's pulled back over the last 2 weeks. We're about 10% off the highs from early in the year. When we look at the breadth readings that we care so much about, we know that we got to a point in June where 60% of all the stocks globally were in long-term, clearly defined upward price trends. So we know in a healthy market over time, a higher and higher percentage of stocks should be participating in a rally, which means there's more and more money being brought in. So there's a little pullback in May, we rallied through June. And in September, we've started to see some deterioration. So we've gone from 60% of stocks in uptrends to 46%. So just less than 1 in 2 stocks headed higher. Now, there's a difference between a stock just pulling back within a long-term trend or a stock actually changing direction. And this is what we're measuring here, the number of stocks that are actually sort of changing direction or breaking their trend. And we can see that when this starts to weaken, it means that our odds of success start to wane and the risks start to outweigh some of the rewards. So we become a little bit more cautious. We raise a little bit of cash. We tighten up the stop losses that we use on all of our positions. If individual positions that we have breach our stop losses, that money goes to the sideline. So this is on a global basis. If we take all stocks globally, if we take all US stocks, breadth peaked early in the summer at 80%. It strengthened through July and August, but has been weakening since the end of August. We're sitting now at 52%. So our global equity risk model has turned cautious. Our US equity breadth model has turned cautious. And our Canadian breadth models turned cautious. So these are our long-term indicators, Canada, US, and global. Breadth is weakening, so it's in red. Our short-term indicators, which include the percent of stocks trading above their 50-day moving average, has been weakening, meaning fewer and fewer stocks above their 50-day. Percent of stocks with positive weekly momentum or upward trajectory is also weakening. Percent of stocks hitting new highs versus new lows has been weakening. And the percent of stocks trading above their 150-day or 30-week moving average is weakening. So all of our short-term and long-term indicators are a little bit cautious. Now, it doesn't mean everything acts the same. When there's a perceived problem, the things closest to the problem sell off first. And then if it gets worse, it will spread to more industries or themes. We know that through most of the year, the equally weighted S&P 500, where you don't take into account the size of the company, just every one of the 500 means the same. The equally weighted S&P has been underperforming the market cap weighted S&P 500. Now, the market cap weighted S&P is, of course, heavily dominated by Amazon and Apple and Google and Facebook, those very large tech behemoths. What we've seen over the last few weeks is actually kind of healthy because the broader market is now outperforming those very large stocks. So where we're seeing the most correction is in those very large, widely owned market leaders. And that has had an inordinate impact on the market. If we go around the world and take all the major markets, the countries that are in green are showing improving breadth, and you can see it's just a very small number. And you can see that the rest of the world is showing some weakness. Now, the US market was the last one to turn down. As you know, we've been focused primarily in the US market. Latin America has been weak for a while. Europe has been weak for a while, not areas of interest to us. Asia Pacific had been stronger in Japan and in China. They've started to show a little bit of weakness also. So I think around the world, there is some concern about this second wave. I think there is some concern around the election. I think there is some concern that there has not been any additional fiscal stimulus passed in the US, which certainly was helping fuel the economy. If we look at a sector distribution, we take all the sectors and we put them in columns based on the percent of companies within each of these sectors that is in a long-term uptrend. And you can see that all of these sectors that are in small letters, that means all of them are seeing some deterioration in breadth. So broad-based, sort of at the sector level, some weakness as well. But we're all not created equally. As most of you know, there are some sectors that we have been avoiding because they just really never got going off the bottom in March. So a prime example of that would be oil and gas. A couple of false starts, but that group is still down 56% since the highs at the beginning of the year. So this is a group that we are not focused in. Real estate investment trusts, we've talked a little bit about some of the concerns around the office REITs and the residential REITs. And some of the risks to a weak economy and real estate. So this group is still off about 30%. It sold off 40% in the sell-off. Now, if you can imagine, real estate loans and energy loans are important to the banks. And if they're having a harder time, that poses a risk to the banks. And so the banks have continued to underperform, down still 41% from the highs at the beginning of the year. So I talk about trying to be targeted in areas of leadership. These are areas that we have largely avoided through most of the year. There have been a couple of attempts at small positions, which just haven't worked out, and we've moved back to the sidelines. Utilities also have in general underperformed the market. The relative price strength versus the market has been weak. So another group that we've been avoiding. So there's been some big parts of the market that we've been staying away from. Now, on the other side, there has been some real strength. And I'll give you some examples. When we talk about technology, a number of different themes, let's take the software companies. This is an ETF that owns a basket of the software companies. You can see certainly they've pulled back over the last 2 weeks, but it's a very different picture than these. So I would characterize what's happening in technology right now as just a pullback after becoming overbought. Actually, on a relative basis versus the market, the software sector is trading still virtually at the high for the year relative to the rest of the market. Semiconductors are similar. Semiconductors are a building block of the new economy. They certainly got ahead of themselves in August, and we talked about a natural pullback. That's exactly what we're getting. So companies like NVIDIA, which provide the semiconductors into cloud-based computing and artificial intelligence. When we look at a point and figure chart of the semiconductor index, it's textbook. X's means it's going higher, O's means it's going lower. So you can see it's been a textbook higher highs and higher lows. That's an uptrend. Higher high, higher low, higher high, higher low, higher high, higher low. So this can change, but at this point, we consider these as a pullback in a bull market. Consumer discretionary, again, very strong group driven by Amazon as the largest holdings, but lots of the consumer discretionary companies have performed well. Little pullback over the last 2 weeks, nothing really to be very concerned about, new relative high versus the market. Home builders would be one of the groups within this category, very close to relative highs. Yes, they've pulled back a few percent, but this is nothing too significant. Nike's a great example, a holding that we had. I know we let a little bit go today just because the market was particularly weak and this was particularly strong, but Nike reported great earnings last night, up 10% against a very weak market. So technology, consumer discretionary have been themes for us all year. They continue to be a theme, and I think they continue to be constructive. They're certainly pulling back, but still very interesting. In the industrials, transportation, railroads, trucking, logistics, we've talked about over the course of time. Been a wonderful sector to be in, pulling back a little bit, but we've had pullbacks along the way, again, very close to relative highs in the market. This includes companies like Descartes or CN Rail or CSX Railroad, companies that are moving things. That's actually a pretty good sign for the economy that there is confidence in this sector. We've had healthcare really from the beginning, biotech, pharmaceuticals, and medical devices. Very small pullback over the last couple of weeks, but trading relatively close to the highs. Medical devices are the same. So this means that we are definitely seeing there are some broken parts of the market which we need to stay away from. And there are some sectors that have had very clear upward trajectories for very good reason, because things are going well within those groups. But certainly we watch each individual holding to say, are they continuing to put out the numbers that we would expect? Are they behaving the way we would expect versus their peers? Now, one of the groups that's pulled back a little bit in the last 2 weeks are the golds, and I just wanted to highlight that for a minute. This is a chart that plots the gold sector versus the S&P. Sorry, the S&P versus gold. So in fact, over the last 2 years, golds have been outperforming the S&P 500. If the S&P were outperforming, this line would be moving higher. So on a relative basis, the golds have been outperforming the S&P, and certainly gold stocks have started to outperform gold itself, reversing a trend that had been in place to 2016. So they are pulling back also as a group, and we have pared back a small amount, but we also think this is a group like the transports, like consumer discretionary, like technology, that are well suited to an environment where there's lots of monetary and fiscal stimulus, where there seems to be lots of money printing, and it's a good store of value. So on August the 31st, we had some red marks in our indicators that were early signs. Today we have a lot more. Correction can go on for a short period of time or a longer period of time. We need to monitor our positions one by one and the makeups of the portfolios. We need to make sure that we stay in leadership. We need to make sure that we aren't seeing significant change. So far, we are not seeing change in the leadership. And we are playing some defense. We do have some cash in the portfolios. If we look at the weightings, our tech weight as of the beginning of the week was down from 30% about 2 weeks ago to 19%. It's actually closer to 14% today on Wednesday. We have also pulled back on some of the materials. We have in the portfolios anywhere, depending on the portfolio, from 15 to 25% cash, which gives us flexibility. We have stops on all of our positions. Should additional stops get hit, there will be more cash raised. But at this point, this looks more like a typical fall correction. The period between Rosh Hashanah and Yom Kippur are the weakest 8 or 9 days of the year historically, and we know that we have weakness in the market typically September into the beginning of October. It also falls in line that tends to happen headed into an election. So we have to step by step work our way forward, continue to reevaluate our positions. In a couple of weeks, we'll start to get into earnings reports for the third quarter, and they should be telling. The earnings estimates actually have been going higher through the course of the summer because the recovery so far has been going better than I think people had expected. We'll continue to watch the COVID cases, and we'll continue to monitor, what's happening in the election. Just from an election standpoint, a Republican win would likely be perceived favorably by the market, just simply because you'd see less regulation and probably more business-friendly conditions. A split or a split of the Congress and the Senate also would be probably seen favorably because it would be gridlock and less disruptive things take place. And probably a strong showing by the Democrats would be perceived more cautiously for certain sectors. Financials is one of them, which we're not in, because there's likely to be more regulation and maybe some more taxes. I think it's unclear what the outcome is there. So with that, Pam, I guess I would open it up for questions. I guess the point that is needless to say, if things get worse, we get more defensive. But we're very defensive now. I'm happy with the way we managed the decline in February, March. We had a great run in the equity portfolios from March through into September that put us way ahead of the indices. We've given a little bit back in the last 2 weeks, but we're in a pretty defensive position and able to weather whatever comes at us.
Thanks, Dave. Would you be able to comment on how we hedge and protect our pools
Sure.
versus raising cash proactively?
Sure. So it depends on the pool. Like for instance, over the last 2 or 3 calls, I talked about the fact that the macro portfolio, we probably got defensive too early, but we wanted to have a portfolio that was set up actually to take advantage of a decline. And so in the macro portfolio, we actually have been short the market over the last 2 weeks and have had actually a wonderful 2 weeks of positive returns against the market. In the other portfolios, we do use futures hedges sparingly, but the raising cash is a little bit less complicated. So when you get those sharp down days, we try and add a little protection with futures hedges by selling the index against our holdings. And that has worked well at times, and it has worked less well at times, so it's something that we're a little bit sparing with.
Thanks, Dave. We spoke briefly about stop losses, wondering if it is normal for us to sell a position when the indicators that we use point to negative in the short and long term, or do our stop losses have to kick in order for this mechanism to occur?
That's a great question. So look, our process is iterative. So when our indicators start to turn down, we will tend to raise some cash, period. So that may mean taking a 5% slice off of all of the positions just to reduce our position size, because we like to have some cash. Once we've done that, then we get down to the security level and the sector level. So if the sector model turns negative, we may raise a little bit more cash like we did with technology. And then it comes down to the individual positions using stop losses beyond that. So it's an iterative process. If I go back to the summer of 2008, which we all would like to forget, the breadth models turned down in June. By a month later, we were about 25% cash, okay? Which, a month after our models here have turned down, or 3 weeks, we're about 20 to 25% cash. That's about the same. Now, it continued to weaken through the summer of 2008. So by the end of July, we were about 40% cash. And by the end of August, we were a little over 50% cash. Now, the real trouble in the market didn't start until October, where it really started to weaken and the market went down, 38 or 40% over 2 months. By then we were 75% cash. Markets don't go straight down. So even if this was going to get worse, you would expect the market to pull back, rally a little bit, maybe fail to make a new high. That would give us more indication that things were going to get worse. Right now, this looks like a garden variety correction, nothing more. But if it continues to get worse, we will get more defensive.
Thanks, Dave. Do we ever use protective puts for hedging?
Protective puts are difficult because you're buying time. So not only do you have to get the direction right, but you have to get your timing right, because a put expires worthless unless it's in the money. By using a futures contract, you're not buying time. You're just buying a price in the market. And so to us, that's a better strategy.
Thank you, Dave. Another question on the team's view on the Canadian dollar versus the US dollar.
That's a good question. So the US dollar has been weakening through the course of the last number of months. And as most know, we had a 100% hedge on our US dollar positions. So we didn't want to make money in the US and lose the value in the currency. In the macro portfolio, that is a more active macro stance, about 3 weeks ago, we went to a 50% hedge because our view was that the US dollar was getting a little bit stretched and could bounce, which would mean the Canadian dollar would likely pull back. And it has been pulling back over the last 2-3 weeks. I think the longer term picture is that we would prefer to be hedged, but right now I think is a tactical opportunity with this pullback taking place to take advantage of a little stronger US dollar.
Thank you, Dave. That concludes our questions for today. Until next Wednesday. Do you have any final thoughts?
Look, I think that what I would say is I want to encourage people not to focus too much on the news. Because when we focus on the news, you focus on high profile things that are in your face that don't necessarily impact the businesses that we're invested in. If we were focused on the news in March, we would have sat in cash all summer long. So by following these breadth models, it takes into account not only the news, but the fundamentals taking place in the themes we're invested in. And many of the themes we're invested in actually benefit going through the situation that we're in right now. Understand that corrections are normal. We're all a little gun shy because of the sharp pullbacks in 2018 and early this year. So I get it. But we just have to go step by step through this process. There's as much risk selling everything and going to cash and having the market turn around and run away on us as there is the market pulling back a bit. So we have to iterate step by step. And if you do have questions and you want to talk about concerns or thoughts that you have, please don't hesitate to call us because our door is always open.
Thanks very much, Dave. And thanks everyone for joining us again. We look forward to seeing you next Wednesday at 4 p.m. Please send your questions or comments to our firm. You can also email me at phastings@barometercapital.ca or pick up the phone and we will have someone answer it and address them accordingly. Thank you.
Thanks very much, everyone.